Broadcast button on the GoToWebinar control panel to allow all attendees.
Sounds good. I'm going to close the door.
Yep. All right, good evening, everybody. This is Ken at Tortoise Capital. It is March 3rd, 2020, middle of the volatility of coronavirus and whatnot, and the Super Tuesday. So it is prudent to step back and think about some of the longer term time frames. And so I'm pleased to be joined by my dear friend, mentor, and sensei, Bill Scheidt from Siwa Beats, my drummer mentor. And he's going to talk about some work that he's been doing really for multiple years now, because it started with kind of blended monthly rebalancing and some longer term investment strategies for family and children and longer term goals than we might typically look at for our day trading and swing trading. So this is a good time, I think, to step back in the middle of all the volatility and just take a longer view. And I'm really looking forward to Bill's work, which is always enlightening and insightful. So Bill, just welcome aboard, and I hope this finds you and the family happy, healthy, and thriving. I'm sure they are. So whenever
Thanks,
you're ready, give it a shot. And I'll drive the slides for you. Just let me know when.
Perfect. Well, thanks again for the honor and the opportunity to present to the Tortoise community. I've certainly gotten just absolutely incredible value from what I've learned from you and everybody in the community. So I'm really happy and feel privileged and blessed to have the opportunity to give back. So what we're going to look at here tonight is a portfolio moving average system that uses SPY only. And we're going to take a look at backtest and simulation research. For anybody who has this PowerPoint, if you download it, advise you to take a look at the view with the notes section visible, because there's some slide commentaries at the bottom that you might find helpful. So with that, let's go to the first slide.
Hey, did you need me to, if you ever need me to expand that to show the notes in this video, let me know. But I was just going to show the slides, but otherwise.
Yeah, just the slides is fine.
Oh, okay.
No problem.
Okay. Thanks, buddy. Here we go.
Okay.
We are disclaimed.
All right. I am still showing on my screen that you're on the first slide. Are you showing something different?
Yeah, I have kind of a slow connection here tonight, I think. So there we go.
Okay.
Here's
cool. Yep. So nothing I'm going to say should be construed as investment advice. I am actually trading this with real money, and you are responsible for your own results. And if you believe you're not, you are responsible for that too. So be disclaimed. And with that, let's go to the next slide.
It may just take a half second for it to catch up.
Yeah, sure, no problem. So on the next slide here, I'll tell you a little bit about what we're going to look at here. So these are the objectives of the research. The objectives are to backtest and simulate a portfolio moving average system composed of only SPY and using SHY for cash. And the goal is to fulfill the uses that I've got in the next 3 bullet points. I just want to also note that this system is functionally the same as using a BMR system of only SPY with SHY for cash if you're using an equivalent length moving average. So for me, the purpose of this system is, there are actually 3. So one is to diversify away from swing intraday BMR and other PMA systems that are lower return, lower volatility. I also see this system can be used as a replacement for BMR systems that are not performing according to the parameters of past research or meeting our objectives. Some of the other BMR systems that I've presented on here for the Tortoise community are actually not performing according to the parameters of past research. So this could be a replacement for that. And then I think also this system would be pretty well suited to safely navigate the next financial or debt crisis. And at the end of this
presentation, where we are now.
Yeah, right, exactly.
Yeah.
And the last couple of slides are an appendix to my original research here. I did a bunch of work over this last weekend to look at how to improve this system for situations like the one we're in right now. So we're gonna spend some time on that at the end of this presentation. I think everyone who's been trading in the last week would be pretty interested to hear some additional rules that we can use to navigate markets like this one. The other objectives here are to compare the performance of these system configurations across a variety of metrics, and also as compared to various configurations of the BMR system that I've traded in the past and others. And then finally, to get an idea of the system performance that a trader could possibly expect going forward, of course, given the limitations and assumptions of what we can do with the simulator.
Okay.
And with that, take it to the next slide. So I want to just outline a few of my big picture beliefs here. I believe that all systems will eventually lose their edge or fall out of sync with the market. So I think developing systems is just simply one of the ongoing tasks of trading practice. Seeing the performance of Finn's BMR system drop out of the bottom of the projection cone from our original research is actually what spurred me on to create this PMA system.
And I want to stop there and just say what was really important about that was the idea of carrying forward that and resetting that projection cone going forward. Because if you have a long-term system that's been doing great historically, but you never sort of update it, you could actually, it would require that system to fall way out of historical norms before you ended up resetting. So I thought the periodic resetting of that projection cone was an important part of keeping a system that's been good for a long while in tune with a rapidly changing world. Go ahead.
Yeah, thanks. Great point, Ken. Great point. Also, in recent years, as a lot of people have seen, BMR systems in general have not been keeping pace with SPY. So my belief is that direct exposure to SPY via a PMA system like this may outperform BMR systems in the immediate future. Of course, we know from your work, Ken, and the work of others that there's a statistical edge to holding SPY when it's over its 200-day moving average and getting out when it's below.
Yeah, let me stop there for a second. And some people ask me why I think that is the case. Here's what I think is happening, that as we go to more leveraged institutional ownership of equities, that the U.S. large caps, and especially the dominant tech giants, have been getting an increasingly larger portion of equity attention. And so that has really been driving the S&P to get to the top and stay at the top. And when that's the case, the other supporting sectors, which historically had been receiving periodic rebalancing and taking their turns as relative strength leaders, that has started to fall off. And so it's less about sector rotation anymore for long-term holding, and it's been more about when the season is for equities, you want the S&P and probably with leverage. And so that's kept the S&P, which has been dominated by tech, nearer the top for longer than normal periods of time. And that is kryptonite to systems that rebalance periodically between a variety of sectors. So I think that's what's happening longer term, and I think that's going to be persistent. That is what my spider sense suggests. So this comes along at exactly the right time, because we can now, for future research, not only look at just the S&P as the equity choice, but also some of the leveraged S&P products when the seasonality suggests that's a good thing to be holding. So go ahead.
Yeah, thanks. Great addition. Great commentary. Another belief I have is that as markets continue to change over time, that we are going to see increasing volatility. And this connects to the idea that using a moving average faster than the 200-day is a good idea. And we're going to see how that plays out in some of the following slides. I also believe that during the next financial crisis, bonds may not be a safe haven as they have been in the past, just due to the inflated prices from all the money that's been printed and all the QE, et cetera, since the last financial crisis. So I believe that using SHY for cash might be a better alternative than bonds.
Yeah,
And
we
bonds is something
especially,
that
yeah, one of the things we know on that is that in the shorter time frames, instruments like TLT treasuries act more like volatile equity instruments than safe haven alternatives to equity. So the shorter the time frame, the more they look stock like and less bond like. So they don't really act as a legit alternative as they may have in the past. Go ahead.
Yep, totally agree. I also believe that before we get to the next financial crisis, we may experience a top, which could include some really big gains in the markets. And I believe that because SPY has been so strong in recent years, it may continue to lead the way during any kind of big blow off top. And I would like to be exposed to that.
Yeah, and I think that's connected back to my earlier comment about why the S&P has really started dominating over sector rebalancing strategies,
Mhm.
and I don't see that changing in the short term. Go ahead.
Yeah, I'm with you on that one. And we may get a really big reset in overall market behavior after the next financial crisis, but I think between now and then, I think exposure to SPY is going to be something helpful and useful. My final belief is that few retail investors achieve the returns of SPY because they use diversification as a way to play defense. So by using a moving average crossover for defense instead, it may be possible to either match or beat the SPY performance, which is something that the BMR systems have not been able to do in the last handful of years.
Yeah, one of the things I noticed here in this sell-off, so we is featured a 10% sell-off that was faster than any previous 10% sell-off, and then it went all the way to 18% sell-off in a matter of about 7 days. But in that time, things that you would have traditionally thought of as defensive plays also got slaughtered to the same extent. So gold, silver, precious metals, real estate, all of those got taken out and slaughtered too. So as we know from other research, that sector diversification when markets are grinding upwards is no guarantee of continued diversification when you start getting these fatter tail events and you get the convergence of sell-offs in the global market where everybody's getting out of everything, which was the explanation for why gold and silver did not benefit from this sell-off in the S&P to the extent you might have thought they would. Go ahead.
Yeah, great point. Thank you.
Oh, let me click
okay,
to
so
the next slide. Yeah. Hold on a second.
Yeah, take your time.
Yeah. Okay.
So I just want to cover some of the limitations and assumptions that are baked in here. So of course, when we use a simulator, we involve the assumption that we have a representative sample of data. So our sample for this research is 156 backtest trades from 07 to 19 as generated by ETF replay. And I do want to point out that we have access to data back to 2003 through ETF replay. However, my belief is that future performance is probably going to be more likely performance. So I chose to go from 07 to 19. And then also, I think that we're probably going to see another financial crisis in the coming 2 to 10 years, probably on the shorter side of that.
Or 2 to 10. 2 to 10.
So,
yeah. Okay.
So I wanted to make sure that I included the 08 financial crisis in this research. So I just chose, well, let's just say 07 to 19, and we'll go from there. Of course, I did this research in January of 2020, so through to the end of 2019 was all the way up to the most recent data that we had at that time. Also, of course, using a simulator involves the assumption that we've seen our worst case loss. I believe that a limited sample from the past cannot capture all the possibilities of an unlimited future. So we should be prepared to see a worst case loss in the future that's likely going to be worse than what we've seen in the past. Also, a really important point here that everything in this research is month end to month end. And so the intra-month drawdowns are likely to be larger than what we discuss here.
all reasonable
Uh,
points of view. And what we know from our volatility research is that when you have a 3-month harsh sell-off, most of the pain is experienced in about a month. And then when you have a very bad monthly sell-off, most of that pain is felt within 15 days or less. And in 10-day
yep.
sell-off periods, most of that pain occurs over 5 days. So the asymmetry of volatile losses leads you to that kind of insight that says be very clear about where your stops are all the time, so that you can define the limits of losses that you're undertaking. Okay, go ahead.
Yeah, and it's fascinating to hear you say that, because when we look at the appendix, the last couple of slides of this deck, we're going to see the advantage of getting out at the when we see those kind of shot over the bow days like we saw last Monday that kind of precede some of that heavy and fast selling. So that's a great point that you just made there. So here's the system rules, and these are the rules as found at ETF Replay. So at the end of each month, the system calculates whether each ETF in a portfolio, and here we're using only SPY, is above or below the user-defined moving average. And then for the following period, the system invests in those ETFs that are above the moving average at the weights allocated to each ETF when you create the portfolio. In this case, SPY is weighted 100%, so the system just invests 100% in SPY when it's above its moving average. And the system moves to cash using SHY when SPY is below its moving average. So it's very, very technically just a very, very simple system, but the results are really quite powerful. So let's take a look at the next slide. For anybody who has ETF Replay, when you look at the next slide here, you're going to see the settings that I used for the portfolio moving average backtest, and you can recreate these settings. So our portfolio is only SPY. The moving average length is 8 months, and that's a simple moving average. We're going to rotate monthly. Our benchmark is going to be SPY, so all of our backtests will be in comparison to SPY. We're using SHY for cash, and our backtest period here is 07 to 19, like we talked about just a couple slides back. So let's go on to the next slide. I want to just talk quickly about why I chose to use the 8-month moving average, because you know, in ETF Replay, you have a lot of flexibility, and I chose the 8-month moving average because in past research that I've done on other PMA systems, the 8-month moving average had the lowest max drawdown, the smallest worst period, had very good median winning periods, good total return, good winning percentage. So I went with that here, and just in doing some quick looks, I found all of that to be true with this system. So the 8-month is what I ended up going with. I think it's also interesting to note that an 8-month moving average is roughly equivalent to a 168-day moving average if you assume an average of 21 trading days per month. So 8 months actually has a slightly front running the 200-day moving average. I think that this is going to be helpful in the case of increasing market volatility in the future, and in case that the statistical edge around the 200 begins to erode. And I have actually seen in my own actual trading results that front running the beginning of the month BMR rebalance date produced improved results. So that may help explain why we get such good results using the 8-month moving average here as well.
Yeah, and that I want to reinforce that dates all the way back to 2009 and 2010, and some of our original research into fine-tuning the days of the month. We studied up to 5 days before and 5 days after the start of the month to determine if any of those gave a advantage about when to execute BMR. And our findings in those cases were that 2 days ahead of time was really a good way to go. And so I'm not surprised to see that a little bit of front running here So that's about a 10% front running if you go from 200 days down to about 180 or 160 in this case. Anywhere from 10 to 15% acceleration. Now let me get, there we go. Whoops, sorry, I went too far. Yeah. So I think next one, results back test.
Yes.
Should be coming up here just in a half second.
All right. Yeah. So in the next slide. I think.
There we go. It'll come back to that. So resulting back test. It'll show here in a second.
Okay. Cool. Thank you. Yeah. One of the things that I wanted to point out here before we look at the data is that in practice, the backtest results will be impossible to exactly replicate because of two reasons. So number one is commissions. Obviously, everyone's commissions are going to vary. But then the second reason is for the backtest results, positions were entered on the last day of the period at the close. Like, so for example, on the close of January 31st, the backtest is gonna look at the data from January 31st. But because ETF replay calculates based on the close of the previous day, in actual practice, it's impossible to invest in those picks from January 31st at the close of January 31st because they're not calculated until after the close.
Yeah, all that really means
that
in a simple system like this, though, is that 15 minutes before the close, you just got to run one calculation on one symbol and make that decision. So in actual effect, it's not the academic difference there is fairly easy to overcome. And that would be the same whether you're front running it 1, 2, or X number of days. So in a simpler system like this, it's pretty straightforward. And I would just, I would just say the TradeStation bundles and the TC2000 bundles have the ability to do this easily as well if you don't have manual calculations. Okay, go ahead.
Yep, for sure. Great points. Thanks, Ken. So as far as data analysis, how I handled the data was I treated the net result of each month's performance over the backtest period as one trade. And then I determined the size of R by using the average loss over the backtest period. And each month's net percent return was converted to an R multiple. Then I calculated all the usual system stats, expectancy, standard deviation, win percent, win-loss ratio, SQN, et cetera, et cetera. And then finally, I simulated everything using.
Oh, I'm sorry, I went the wrong
by
direction.
Mike Bryant, which is just absolutely just a brilliant tool. I would highly recommend Market System Analyzer to everybody. So now looking at the backtest results here. Oops.
There we go. I got.
We can go back.
I got flanked out of the way. So we're back to the backtest results here just in a second.
Yeah, sure. No, there we go. Yep, perfect. So these are the backtest results as displayed by ETF Replay, which is also a great tool I highly recommend. So as you can see here, the green is the backtest, the blue is the SPY. So the system has a greater return than SPY, 300% versus 196, at a lower volatility, 11.6% versus 19.3. So we get a better return at lower volatility using this system than if we just did buy and hold with the S&P 500.
Yeah, even if you notice in the period of maximum drawdown highlighted by the gray bar, you'll notice that the portfolio rules actually smooth out that painful period where you get multiple sell-offs and gyrations down here in the buy and hold. It is a smoother path, even through the period of maximum drawdown. So just as a point of comparison.
Yeah, thanks, Ken. Great point. So let's take a look at the next slide here.
Okay, it's coming up.
Yep, take your time. So when we get there, what we're looking at here is the summary statistics for the backtest from 07 to 19. So one of the things you'll notice here that this is basically a coin flip where you win almost 75% of the time. Your winners are slightly smaller than your losers. Worst period is minus 7.95%. However, for comparison, the S&P's worst period was minus 16.52%. That was in October of '08. Also, an interesting note that in February of 2020, so just this last month, the system was down 7.92%. So that's about as ugly as we've seen. The system's max drawdown was 16%, whereas S&P had a max drawdown of 55.2%. And the compounded annual growth rate for the system is 11.3 versus 8.7 for the SPY. And just to go back to looking at the worst period stats, again, when we get to the end of the slide deck here, the research on the shot over the bow days is going to give us some ideas for how to make that quite a bit smaller. So in our next slide here, what I've done was compare this PMA system to Finn's BMR system, and that's the one that I had been trading previously, and I'm now using this system as a replacement. So because I'm using this as a replacement for Finn's BMR, I thought it was instructive to compare the back tests. So for the period of '07 to '19, Finn's BMR has a total return of 563%, while the PMA SPY system has a return of 301%.
Yeah,
however,
so this is a system that you were using for his long-term, college and any financial goals that he's got. And then I think you'll make this point here is that about 4 years ago is when I think that dominating focus of attention on the large cap winners in tech has really changed the game completely away from sector rebalancing among a set of peers to that 600-pound gorilla of the S&P driven by tech really becoming the 1,800-pound gorilla of the S&P. Yeah. Go ahead.
Yes, exactly. And that's what the stats are showing. So if the most recent 5 years from 15 through 19, the BMR system has a total return of 15.1%, while the PMA SPY system has a total return of 50%. So yeah, Ken, that's exactly what the data is pointing to here. So with that, we can
I'm going forward
switch to the next slide.
It'll be up in a second.
Awesome.
There we go.
There we go. So here we've got just a little bit more data in terms of the backtest comparisons. And again, we're kind of showing the same trend here. So for the period of '07 to '19, the BMR had a compounded annual growth rate of 15.7 on a max drawdown of 22%, while the SPY PMA system had a compounded annual growth rate of 11.3 on a max drawdown of 16.4. However, again, when we look at the most recent 5 years, 15 through 19, the BMR has a CAGR of 2.9% on a maximum drawdown of 22%, while the SPY PMA system has a compounded annual growth rate of 8.6 on a max drawdown of 16.4. So, once again, we see that the PMA system is outperforming the BMR system in the most recent handful of years.
Okay, going forward, next one, it'll be up in a half a second here.
Fantastic. So as a sneak preview, what we're looking at here is the annual performance year over year as compared to SPY, and we also have the maximum drawdown for the system and the maximum drawdown for SPY. I think what's really interesting to note here is that the system only lost money for 1 year. That was during 2015. So during the entire 13-year backtest period, we've got 12 out of 13 years making money. One thing I noticed was that I've researched other PMA systems, and I found this exact same pattern to hold true for those. So I'm thinking that what's happening here is that the PMA concept was just out of phase with the market during 2015, which of course means that could happen again in the future. And that it's probably not a function of how you configure the PMA system, but more a function of how the overall logic of the system interacts with what the market's doing at that time.
Yeah, there's a correlation here when Bob Rourke and I have been talking about this, and that is any system that is based on a calendar periodic look back becomes vulnerable to exogenous events, or said another way, when either natural or unnatural circumstances conspire against the regularity of a calendar. So we're seeing, as an example, in that the AI ETF, ticker symbol WIZ, is a system of systems, and it has a blended model of best practices from a variety of artificial intelligences. But it only rebalances its holdings at the start of the month. And so even though the circumstances about the markets change earlier in the month, and when obvious technical levels are broached, it doesn't rebalance into what they call the bear fighter portfolios until the end of the month. And so any system that is only using calendar rebalancing now is going to have a certain systemic risk when we see more and more algorithmic type trading is going to occur. Now, I think that what you've got here with a combination of using trailing stops to limit losses regardless of the time of month when it hits is a way to offset some of the great pain, as shown in the upper left-hand corner here. But that's just one of the trade-offs that you end up making if you want to resort to simple systems that use periodic lookbacks. That's just part of the environment that's out there now that you have to deal with. So go ahead with your the back tests here.
Yeah, thanks. It's a great point. And the addition of the shot over the bow rule was actually spurred on by that exact thought process, Ken. You know, I was watching the markets and saying, dang, this system doesn't rebalance till the end of the month, but I can already feel that the markets have made a sea change. So in a couple slides, we'll take a look at a possible response for that. And just to make a note on the annual performance stats, we were looking at a slide back. I thought it was really interesting to look at how the PMA SPY system did in 2008, and that's what we've got up here on this slide that we're looking at now.
Yep.
While the SPY had a maximum drawdown of 47.6% and an annual return of minus 36.8 in 2008, this system had a maximum drawdown of only 2.2%, and it actually had an annual return of plus 6.6%. So
yeah. So what I want to say about that is the following. So Jim Carroll and I talk about this all the time. He's got a system that that shorts volatility, and under most cases, that's a really good idea, except for when it's a bad idea. And so when that system parameter hits stop losses, or in this case, when this longer term system now suggests going to SHY, you don't mind being in cash during those massive sell-offs that you see here, and then rejoining the
Nope.
But what you miss is the volatility that's available in both directions. So you get these collapsing dragons, I may call it that way, and then the owl entries that capture it the other way. So rather than trying to optimize a longer term system that fits everybody's needs forever, which is only going to be back tested anyway, it is my firm opinion that these longer term systems not only give you investable opportunities for the long run, but also can act as signals and information devices that tell you when that you should consider shortening up your time horizon if you want to try to get measured pieces of these very volatile moves. And that is the essence of the core and turbo approach that we use when we talk about going from the longer term position sizing as core and using swing trades as the turbo, or if you accelerate that, using swing trade positions as core and intraday positions as turbo, or inside the day using longer term candles like 30-minute and 2 hours as the core, and then 1 and 3 minutes as the turbo. So there's ways that you can use trading systems of a certain time frame to act as information signals as well as their investment vehicles themselves. And so just by a quick inspection of these longer-term macro moves in the broad market that unfold over weeks and months and quarters, I think that illustrates the point as clearly as it can possibly be shown. So thanks.
Yeah, thank you. That's really fantastic. I'd never thought about using the system as an information displaying device or tool. That's really, thank you. That's fantastic.
Yeah, there's a certain efficiency in that. So rather than having a separate set of systems that, you know, take actions in the market and then a separate set of indicators, you can actually use the performance of a system as an information generating device as well. It has information content as well as supporting particular specific decisions. There is information content in the system as indicator frame of reference. So that's what the point I want to make on that. Okay, anything else you want to make on this chart, or are we going forward?
Yeah, we can go forward. We're good.
Okay. Okay, so this next one's going to show the usual system summary stats. It should be up in half a second.
Yep, you got it.
So for those listening at home, the whole idea of core and turbo is an absolutely essential element of the core tortoise strategic approach in any time frame. Go ahead.
There you go. Yep. So here we have all of our usual system stats here. You can read them for yourself. I think of particular interest is we got a very good SQN 100, a very good SQN-N. You know, by Van's subjective standards, he would say that you know, an SQN of 3.48 and 4.35 are an excellent system.
Yeah, in my view, those are, that just mean at some point the upper limits of those don't add even more credibility. It just simply, I'm just willing to say good enough to trade going forward.
Right, exactly. That's the summary note on this slide.
Yeah.
Good enough to trade.
Yeah, I don't want to go off the deep end by overestimating the value of individual statistical measures. Because I also believe, as you do, as you pointed out earlier, we haven't seen the worst day. I talk about this, if I may just take this moment. I'm going to fast forward to get to the next slide, but I call this kind of the 80-20 rule, and that is when I'm talking with professional officers who use a reliable doctrine to guide their activities in a dangerous world, I remind them that the doctrine on its best day can only be 80% useful, because it's based on what the world has shown you already, and the world always has more cards. You haven't seen all the cards in the world's hand, so there's something else coming, and so you have to have something that allows you to go beyond the limits of your doctrine, or in this case, the limits of a really good long-term system, in order to be able to respond to the 20% fat tail events that are just waiting out there, just waiting for you. Taleb would go a little bit further and say this is the fourth quadrant problem, that that the fat tail events are things that you can't predict and you haven't seen, and so you got to be prepared for those more now than ever before. So go ahead, the simulator.
Yeah, thanks. So this is a graphic that comes from Van Tharp's Position Sizing Home Study course, which is an absolutely fantastic course. I highly recommend it. In my view, that the information in that course is essential information for all traders. And one of the things that I wanted to just point out here is that with a system that has a 74% win rate, over 100 trades, the maximum losing streak at 95% confidence is 6. And so, you know, you just want to keep that in mind if you were going to be planning to trade this system, that at 95% confidence, you would probably not exceed 6 losing months in a row. Just an interesting point. I always like to make sure that my psychology is straight and I know what I'm getting myself into when I'm trading a system. And so losing streaks for me is an important statistic to look at, which is why I included this one.
Yeah, losing streaks are the ones that leave scars. Winning streaks are ones that let you talk about things at parties. Losing streaks leave scars.
Right. I always tend to focus on let's play defense first and let the offense take care of itself.
Yep. Okay, I forwarded up to the next one here, the equity curve and performance.
Great. Yeah, thanks. So what we're going to get into here in the next couple slides are the results that come from Market System Analyzer, which is just absolutely a fantastic tool. It's definitely one of the key pieces of equipment that I would recommend all traders have in their toolbox. It's created by Mike Bryant. So this is the current sequence equity curve and performance summary of all the backtest data here. A lot of this is captured in the previously presented equity curve from ETF Replay. But speaking of winning streaks and losing streaks, one of the interesting pieces of data that we can see here is that the maximum consecutive winning trades was 15 and maximum consecutive losing trades was 3. I found it very interesting to note that this is really close to another PMA system I researched that has 5 ETFs, and the stats there were 15 and 4. So here it's 15 and 3, there's 15 and 4. So again, I think we're seeing where the PMA system idea has worked pretty well over the last little while.
Yeah, before I forget to say this, what I'd like you to look at as a separate one on downstream is to take a look at when this system says SPY is the right answer, then take a look at putting a portion of that into the SPXL, the triple leveraged ETF, to get some juice on the S&P, and then treat that with like about anywhere from 1/10 to 1/4 of the portfolio with a tighter stop on that, so that in periods of maximum outperformance, like you've seen in the last 4 years, that you get an even larger portion of boost, but with the same kind of strict risk control. And then I think also that if we looked at that also as with two different, a fast moving average and a slow moving average, you might use the faster moving average for the leverage portion, and that way you get a stepwise approach in, so it's not all or nothing, and that will tend, I think, to smooth this out even a little more. Okay.
Thanks, great idea. I'll definitely do that research. Thank you.
Okay, I'm going to fast forward to the next one here.
Yep, absolutely. So what we're looking at here in the next slide that's about to come up is a simulation of 1,000 runs of the 156 trades in the back test with percent equity position sizing at 100%. One of the interesting things to note here is the first time I ran a Monte Carlo using percent equity position sizing at 100%, I was very surprised that the right side converges the way it does. But I checked that with Mike Bryant at AdaptTrade, who's the creator of MSA, and he says, yeah, that's probably correct.
Yeah. So the white line here represents the mean performance of the Monte Carlo run of 1,000 iterations, and then the red and the green represent the outliers of probably +1 standard deviation.
95. Well, the top one is 5% confidence.
So the two. So that's the two. In the future runs, if you get a chance, I would also put the +1 standard deviation band in there too, and that might be an indicator of, hey, I haven't reached that time to go all out, but you might even go to half positions on the downside, or adding a little bit of leverage on the upside when you get to those extreme moves. There's some ways that you could, for example, put the OWL parameters on your portfolio equity, and you might discover some interesting ways that when you start seeing the reversion to the mean, and I'm going to show on this one that when you get this series of higher lows on the equities, note the acceleration that you get here, and that's a case where the S&P, which has underperformed the rest of the world, is really starting to catch back up. And then if you believe in the S&P as a focus, you would see a lot of momentum players starting to add leveraged S&P positions, so you get that second leg up is really powerful in the S&P, and that's the moment I believe that we need to start capitalizing on leveraged S&P in order to take advantage of that phenomenon. So when you see higher lows in the equity curve with a 30-period smooth look, 30 trade look back period, that's where I think we want to start using that OWL technique and some of the statistics to add a little more timing to this. So we'll study that for later in the year. Go ahead.
Another brilliant idea. Thanks, Ken. So yeah, I think we're good. We can flip on to the next slide here.
Yep. Here we go. Yeah, I'm going to skip that because we got about 5 minutes left before I got to start this next one here. But the results of the simulations give you the standard portfolio accounting performances and then the monthly performances that come out of MSA, so you can get to see all of that stuff. So I'm going to run to slide 24 here real quick and then just show the simulation comparisons. That's going to come up here in a half a second for you. There you go.
Yeah, there you go. So we have basically we just have the different maximum drawdowns and compounded annual growth rate looking at 17 to 19. There's the PMA, SPY, there's FIN's BMR at full position sizing and then at 75% position sizing. So I mean, basically what we can see here is that there is a pretty nice edge to trading the PMA, SPY when you just look at what are you risking versus what are you making.
Yeah, I think the increased CAGR of FIN's BMR is reflective of those periods of time when it was outperforming, and you get great payoffs. Yes. But the corresponding downside of volatility, you can see in the difference in max drawdowns. And so although the CAGR is smaller on PMA, I think that is more fine-tuned to the current state of volatility and shouldn't be used as the only reason to judge, because this might drive you back to FIN's BMR, and I don't think that's a good answer. Okay.
Yeah, exactly. Ken, if we only have just a few minutes left, I would suggest we skip to slide 27 and we take a look at the shot over the bow rule.
Yeah, I think that's the important one. It should be up in a half a second here.
Okay, great. So just to jump ahead a little bit while that's coming up, February of 2020 is the second time I've seen a shot over the bow day. The first was in October 18, and I just noticed how uncomfortable it felt to be long the BMR and PMA systems because those breaks in the market just felt like such a significant sea change. So I said, what can I measure about these days so I can objectively quantify and describe them and then be able to identify them again in the future? And then what would it look like if I got out early at various times during the shot over the bow moments, and then how could I add some rule to the system to provide a quantifiable edge? So what I'm going to suggest is that we skip to slide 33 next, and this is a summary of the statistics that I found when I compared the shot over the bow day from just last month and October of 18. I found that there were a lot of commonalities between those days, and while there were a number of commonalities, the biggest one was a price change, a drop of 3% or greater close to close on the shot over the bow day. So I went back 2 years to February of 2018, and I found that there were 5 instances of price drops of 3% or greater on a close to close basis. So
what makes that interesting? What makes that interesting, just while I am keeping this out of my head, is that 3% turns out to be the long-term weekly ATR of the S&P. So what that means is, when you experience a week's sell-off, a routine week sell-off, but all in one day, that's like 5 times the significance in that sense, and that should really get your attention. That is like the difference between a noise in the night and a thunderclap. So go ahead.
Right, exactly. So I asked myself, well, what would happen if I exited the system at 3 different points? So at the close of the day of the drop, the shot over the bow day, at the opening of the following day, and at the close of the following day. And then I compared the results of those 3 exits to just continuing to hold till the end of the month. So in 3 out of the 5 instances where we had a shot over the bow day, exiting would have improved the returns because the markets continued to drop after that shot over the bow day. The improvements there were in those 3 months 8.11%, 2.76%, and 7.52%. In 2 out of the 5 months, exiting early would have decreased the returns but the decreases were only by 2.93% and 3.04%.
Yeah, so the real answer on this one is it's not the precise moment of exiting, but it's the act of exiting when you get a significant warning. It's like you don't have to tell me twice to get out. I heard you when you lost a week's worth of value in a single day. That is the sign. That's the sound of red alert, if I may say it that way. Yeah.
Well said. And just to further prove the point you made, that big box at the bottom there.
Yeah.
If you get out at the close of the drop, you have an overall improvement of 12.5%. Yep. And if you get out the next day at the open or the close, your improvement is about 10%.
Yeah, so it's always getting out is always the right answer. And I think of rest in peace, St. Robert Gardner. I would rather be outside wishing I was in than inside wishing I was out. So the other thing I'm going to say too, as we're winding up in time here, is that you can even just look at weekly and monthly charts with the RLCO, Bollinger Band, and MACD histogram for seasons, and the belly of the dragon and the RL10s or even the PSAR exits. Those all give you sufficient reason to get out well before waiting to the end of the month and then just doing the periodic rebalancing. That when you take a look at those weekly and monthly charts that I show on each of the weekend reports, and if you just get in the habit of looking at those, it will very much reward your time as you think about those anomalies and those special cases. It doesn't take long to look at them, especially when you're focused on getting the market call right. So at the expense of 1 minute a week, you will do yourself a tremendous amount of good by being able to place long-term support and resistance levels into context when you're thinking about when to use a little bit of intuition or when to use your spider sense or when to start protecting against these exogenous events. Okay, go ahead. There's the shot over the bow rules on slide 34 for you.
Yep, there it is. So the rules are, if it drops greater than or equal to 3%, exit SPY ideally at the close of the drop day, but if not, just get out at the open or the close of the next day or anywhere in between. And then at the end of the month, just reposition per all the usual system rules. So you'd remain in cash or by SPY depending on all the calculations at that time. Yep. And that's all she wrote.
Yeah. Hey, that's we're pushing up on the time right there, almost exactly to the minute. So I'll get this cleaned up and posted. Thank you so much for this work, Bill. And there's some ideas in there for you to work on. If after you listen to that again, take some notes on there, and we can talk through if I was not sufficiently clear on some of these the next generation improvements. That'll give us something to look at when we are looking in the June and July timeframe. But I think there's something in there that's really useful, and so that's why I've been concentrating in my own trading lately on UDOW and SDOW as being the triple leveraged Dow and the S&P, and I'm finding that is by far better than looking at Wiz and all its artificial intelligence glory. Just simply using weekly and monthly charts and the leveraged indexes gets you into those things when the going is good, but it also protects you against those exogenous events. And so the standard exit rules allow you to take advantage of just the power of the market. So I think if you get that right, 50% of this stuff is in the can. And so I just want to thank you again. Much love and to the wife and the boy. You guys are in my heart all the time, always on my mind as I do this work. And so just pleased to see you growing in skills and confidence and competence in this, taking responsibility for your own long-term investment. I think you're on the right track. You're using the tools, you're developing your tool skills, and then applying them in a very sensible way. And I'm so grateful for your willingness to share with the members of the community and point to you as evidence of what happens when you take responsibility for your own results and then add skills to that and then share that with the community for critical thinking and additional insights. That's the power of collaborative learning in the community of practice. So +1 to you. I'll be in touch a little bit later on this, but I got to roll to the next one because I got people standing by wondering just where am I again. So thanks so much, buddy.
Ken.
Take good care.
My pleasure. Thank you. Cheers.